Hello everybody, welcome to Zeppe Invest. I hope you all have a magnificent day. I just hit the 300 subscribers. I'm very thankful to everybody who is commenting and liking the video. It really helps me out. So let's begin with the topic of today. 3 stocks to buy in February 2020. First things first, let's take a glimpse to my last 3 picks of January and how they performed in the last month. I know that's only on the short base, but we're just doing it for fun anyway. PayPal is up 8%, Alibaba is up 8% as well, and PepsiCo is up with 3%. I do have to say the market has a very good month, but still these are strong numbers. Alright, for this month I have 3 solid dividend picks for you. All these companies are well established companies in my opinion and existing for more than 10 years. My first pick is Caterpillar. Let's start with a fun fact. Did you know that Caterpillar is responsible for over 100,000 miles of railroads in North America only? They are just building a better world. They are manufacturing and selling construction and mining equipment. They are founded in 1925 and currently have over 100,000 employees. If you take a quick look to the 5-year chart, we can see they are up with 80% in the last 5 years. In the last 12 months, they are up 18%. They have a market cap of 81 billion, a PE ratio of 13.62, they have an EPS of 10.85, and they have a nice yield of 2.8%. So, let's take a closer look to the dividends. They have a payout ratio of 38%. They have grown their dividend and increasing the dividend for over 26 years. The 5-year yield on cost is 4.77%, so that's pretty good. The last 10 years they have grown their dividend with 8.45%. Let's compare all these numbers to a big competitor, CMI, Cummins. On the 5-year chart we can see here that they are up with 22%. In the last 12 months, 16%. They have a market cap of 26 billion, a PE ratio of 11.69, EPS of 14.86, and the yield is sitting at 3%. So we can see that the yield is a little bit higher than Caterpillar. So let's jump into the dividends. The payout ratio is sitting at 35%, so pretty good. They have increasing the dividends for over 14 years. The 5-year yield on cost is 3.71%, and in the last 10 years the dividend has grown with 21.5%. So these are very good numbers if you compare them to each other. So let me know in the comment section who is a better buy do you think. Let's take a quick look to the last earnings report of Caterpillar. We can see that sales and revenue declined with 6%, and profit per share went to 2.66, declined with 8%. So on the first look, those are not very good numbers. The capital structure. In total, they given 1.8 billion back to shareholders. This was around 600 million in dividends and 1.2 billion in buying back shares. The total balance sheet cash is currently 7.9 billion, and this year they contributed 1.5 billion to pension contribution. My second pick of this month is Starbucks. Did you know that the round tables in Starbucks shops are meant to feel you less lonely if you are a single customer? They have a total of 346,000 employees. Those numbers are pretty amazing in my opinion. If you take a quick look to the 5-year chart, we can see they are up with 110%. In the last 12 months, they are up with 40%. The market cap is currently sitting at 110 billion. The PE ratio is 30, so pretty high. The earning per share is 3.05, and the yield is currently sitting at 1.75%. So let's take a close look to the dividends. We can see the payout ratio is currently sitting at 53%. They have grown their dividends and increasing it over 10 years. The 5-year yield on cost is over 4%. In the last 5 years, they have grown the dividend with 22%. So this is one of my watch lists. I will check it out at the upcoming earning release at January the 28th and maybe buy it. Let's compare the numbers again with the competitor, Dunkin' Brands. we can see they are up 65% in the last 5 years. In the last 12 months, 22%. They have a market cap of 6.5 billion, so the company is pretty small compared to Starbucks. They have a PE ratio of 25. The EPS is 3.13 and they have a yield of 1.91%. About the dividends. The payout ratio is 47%. They have grown their dividend and increasing it for 7 years. The 5-year yield on cost is 3.27%, and in the last 5 years they have grown the dividend with 10%. We can see that Starbucks had 3 beats out the last 4 earning reports. And in the last earning report, a quick highlight, the net growth stores in China went up with 16%. That is something that I really like, and I will follow up in the next earning, again the 28th of January. The EPS was up 84% year over year, and they repurchased 581 million to shareholders. So it's a dividend growth company that I'm putting on my watch list for the upcoming years. My last pick of this month is Cisco Systems. Did you know that Cisco Systems provides free training in their networking academy program? They develop and sell networking hardware, software, telecommunication, equipment and other high-tech services and products. If you take a look to the stock chart, we can see they are up with 90% in the last 5 years and only 5% in the last 12 months. They have a market cap of 207 billion, EPS of 3.24, they have a PE ratio of 15 and the yield is 2.86%. So let's take a close look to the dividend. About the dividend, the payout ratio is 43%. They have grown their dividend and consistently increasing it by 8 years. The 5-year yield on cost is 4.98%. In the last 5 years, they have grown the dividend with 13.27%. All these numbers are very good in my opinion. But let's take a look to the competitor HP Inc. In the last 5 years, they are up with 30%. In the last 12 months, they are down with 5%. They have a market cap of 32 billion, a PE ratio of 9.70, and the EPS is currently sitting at 2.27. The yield is 3.21%, so we can see they're paying bigger yield than Cisco Systems. So let's take a quick look to the dividends about HP Inc. We can see the payout ratio is 30.8%. They have grown their dividends for 9 years. The 5-year yield on cost is 3.87%. In the last 10 years, they have grown that dividend with 16.30%. Let's take a quick look to the last earning of Cisco Systems. The revenue highlights from the infrastructure was up with 1%, application up 6%, security double digit with 22%, other products again double digit, the services 4%, that's what I really like, and the total was grown with 2%. For a well established company, this is not very a lot, but growth is growth. And they had 4 beats out of 4. Thank you very much for watching until the end. I hope you have a magnificent day. Please hit that like button because it really helps me with growing my channel. And I'm out. Bye bye. Peace.